This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, and Bloomberg Originals.
And a very good afternoon, everybody. Yes, indeed, we are across Bloomberg platforms. Carol Massar, Tim Stenovec, live here on Bloomberg Businessweek Daily. And gotta say, safe to say, too, on this Monday, beautiful morning in New York City. I don't know how you felt when you walked out this morning, but it was gorgeous because it was hot over the weekend. We also have some optimism on Wall Street.
Yeah, we really do. The S&P 500 is set for its best day going back to April, up 1.8% right now. We're going to have more from Charlie Pellet in just a minute. U.S. Treasuries up too, Carol. Oil slumping. The optimism, thanks to enthusiasm that the U.S. and Iran are agreeing to reopen the Strait of Hormuz, it fuels hopes for an end to the conflict that has really taken markets for a ride.
And I feel this is so indicative of what we have often seen. Optimism in the major averages overall, but go inside the S&P 500, not quite an even split. 282 names gaining today, but still, Tim, you've got about 220 to the downside.
Yeah, I kind of heard you looking around a little bit for some gainers earlier, and I'm like, come on, markets are up 1.8%. It's got to be everything.
Yeah, exactly.
And it's not.
All right, it isn't everything, but we're going to talk about really a lot of macro issues that are shaping the trade. We've got a lot of macro things going on this week. And of course, we've been talking about what looks like some movement forward when it comes to the U.S. war in Iran. We did see the U.S. and Iran agreeing to reopening the Strait of Hormuz, so fueling hopes for an end to the conflict that has roiled markets and has gone on, safe to say, longer than everyone anticipated. Now, President Trump weighing in on it earlier from the G7 summit of world leaders that is underway in France. He said some things. He did so standing beside French President Macron.
The strait is already partially opened. As you know, they're doing a little hunting for a couple of mines that they've already found. But it's essentially ships are starting to go out now. On Friday, it'll be completely opened.
All right, that, of course, was President Trump earlier, sitting beside French President Emmanuel Macron at the G7 meeting of world leaders underway as we speak. Now, the war and an end to it, as we keep saying, is top of mind. But, Tim, I want to say, and we had some caveats last Thursday and Friday, that we have been here before. The devil's always in the details, and there's some very important key issues that have yet to be worked out.
Yeah, including enrichment of uranium and what to actually do with the nuclear material. Also, a former fellow at the White House's President's Council and Economic Advisors of the 3 Ds from the Iran war. All
right, we're going to get into that. Plus, day 2 of trading for the SpaceX company, of course, publicly, or went public, I should say, on Friday. We continue to see that stock soaring. David Bauer, head of equity capital markets over at JPMorgan Chase, they were one of the lead underwriters on the IPO, joining us along with Bloomberg IPO reporter Bailey Lipschultz. So we've got a lot coming your way. We're going to talk macro, we're going to talk Fed, we're going to do it all.
All that and more over the next hour right here on Bloomberg Businessweek Daily. First up, though, a check on the day's trade and top business stories. Here he is, Charlie Pellet.
Right, thank you very much, Tim and Carol. Carol mentioned SpaceX up right now by 17.1%. Got to keep in mind that IPO day last Friday, it was up 19%. So to underscore, SpaceX rocketing higher, up now by another 17%. Do want to begin with a couple of headlines. Right now on the Bloomberg, NVIDIA set to raise $25 billion from an investment-grade bond sale. NVIDIA shares, they're pushing higher now. NVIDIA up by 3.2%. And Centene is going to be offering buyouts to most employees to cut expenses after membership in its health insurance plans dropped steeply over the past year. Centene shares, they're trading lower now, down by 3.8%. Stocks so higher, we are off session highs, up 127 now on the S&P. That is a gain of 1.7%. The Dow up an even 600, up now by 1.2%. NASDAQ up 3%. The NASDAQ 100 index doing just about the same there, up by 3% as well. The MAG 7 index up 2.7%, with the SOX up 5.1%, and the VIX now just above 16. 10-year, 4.46%, with the 2-year, 4.01%. We've got the 30-year, 4.97%, and just want to correct on the 2-year, 4.06%. Spot gold up $102 the ounce, $43.22 the ounce, up 2.4%, while West Texas Intermediate crude down 5.2%, $80.45 a barrel. Brent Brent crude 83.15, down now by 4.8%. Recapping, stocks higher, S&P up 1.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Carol and Tim, that's a Bloomberg Business Flash.
It is indeed. All right, Charlie Pellet, thank you so much. Well, President Trump brought a thread of positive news as he arrived in Europe earlier today for a Group of 7 meeting. The president, however, Tim, still facing plenty of challenges abroad, as we know, as we really await the specific details on a deal to reopen the Strait of Hormuz. We have yet to see what exactly has been agreed to.
Yeah, still the president out on social media saying ships are starting to move, many loaded up with oil out of the Strait of Hormuz. He continued, quote, "They are going along the Southern Highway, which is totally safe, secure, and pristine. There are other areas of travel." Also, the president out on social media earlier today. That was just a little after 9 o'clock this morning.
All right, so that was earlier today. A lot going on. For more on where we are, what we know, what we still need to know, we head to Geneva and to Bloomberg News Washington Correspondent Tyler Kendall. Tyler, good to have you here with Tim and myself. Rather gorgeous behind you. There does seem some optimism in the marketplace as well over progress, or what seems to be progress between the U.S. and Iran. What exactly do we know has been agreed to, and what is still yet to be known?
Well, Carol, at this point, a senior administration official has outlined that the main contours of the deal are the ones that we've been tracking at this point for a few weeks, right? This is going to be an extension of the ceasefire with 60 days. Then we are going to see the Strait of Hormuz prioritized to be reopened and the U.S. lift its naval blockade. That will then kickstart this second phase of negotiations that are more formalized around potential curbs to Iran's nuclear program. The thing is, even within these parameters, we're already starting to see some differences emerge, particularly when it comes to the future of the Strait of Hormuz. We heard President Trump earlier today say that the long-term goal is that it's going to be a free and open strait without tolls. And while Iran has confirmed that for that first 60-day extension, there will not be tolls, we got some indications from Iranian state media earlier today that Iran does plan to impose fees after that 60 days related to what they say would be navigational services, insurance services, and environmental services, and also seem to indicate that Oman would play some sort of role alongside Iran in the administration of the strait. These are conditions, of course, that we wouldn't expect the U.S. to get behind. So perhaps we'll get some further clarity once this memorandum of understanding is released or after this 60-day negotiating period. Another big thing here is what are those curbs on Iran's nuclear program going to look like? We do expect those discussions, Tim and Carol, to come in this later phase, but there has been some reporting that maybe we could be looking at some firmer commitments actually written in this agreement from Iran, including when it comes to their stockpile of highly enriched uranium and potentially a moratorium on uranium enrichment. Of course, these would be rather significant if they really are included in that agreement.
Tyler, it looks like certainly markets are really loving what they're hearing right now. We're going to talk more about that in just a minute. But I wonder specifically about the military assets that are in the region. They're just going to sort of be there for at least 60 more days. And to me, it would seem like, okay, well, this thing is really over when those assets and those people start to return to the United States or wherever they were based before.
That's a really good point, Tim. And actually, a senior administration official briefed us reporters within the last 2 or 3 hours or so and was asked directly this question. And they said that for now, U.S. military assets are going to remain in place. This actually was one of the sticking points that Iran said that they wanted to see included in the deal. You remember last week when there was a lot of speculation, different sides were saying different things. In the draft memo leaked from Iran's side, one of the components was that the U.S. would withdraw forces from the region. But so far, this administration is saying that that's not going to happen and that they do remain poised and ready just in case there is an escalation. That has long been the Trump administration's point of view here. I think it's fair to say that they have prioritized diplomacy. They want to see a deal get done, but also there is that threat and that risk of escalation after last week marked the worst flare-up in fighting since the ceasefire was announced back in April. But looks like we've gotten this close to maybe getting this deal really over the finish line with a potential signing this Friday here in Switzerland.
Tyler, the devil is in the details, and again, we're waiting to see exactly what has been written down and agreed to. But having said that, some folks were saying that a lot of what's been agreed to is very similar to what President Obama did during his term and tenure in the White House with Iran specifically. Is that true, or what do we know?
We're waiting to see where the curbs on Iran's nuclear program are going to fall. And it seems like, according to reporting first reported by the New York Times a couple of weeks ago, that they're zeroing in on 4 aspects that could make a difference. One would be if there is a permanent moratorium on uranium enrichment. That's something President Trump has said that he wants to see. It appears the reporting indicates maybe the sides will land around 15 years. That would be longer in duration. There are also questions here about what an inspection regime would look like, and perhaps that could be different from the last deal. A senior administration official last week said that they do expect Iran to pledge in this memorandum of understanding to dismantle their nuclear program. What that actually means in practice goes to your point about the devil being in the details. Would that mean actually shutting down the 3 nuclear sites that we saw the U.S. target in last June's operation against Iran? Those are the areas that we're watching really closely here to see where those differences really do remain, and if this deal that gets over the finish line is substantially different.
Yeah, it's tricky, and we know it's complicated, and everybody said that getting this finally brought to an end would be difficult, and we know there's a lot to be yet known. Tyler, thanks so much. We didn't even talk about Israel, which we know has continued to strike Lebanon, so there's a lot of issues that are out there. That is, of course, our Tyler Kendall, Bloomberg News Washington correspondent. She's following the president at the G7 meetings overseas.
Hey, let's get a market read on today's news. This week's Fed meeting, which, yes, it's the first coming from Kevin Warsh.
Yeah.
With us in studio, Jason Draho, head of asset allocation at UBS's chief investment office. It's got close to $6.9 trillion in assets under management. I want to start with the war, Jason, and the optimism that we're seeing in today's trade. As we just heard from Tyler, a lot of the devil is in the details, but it sort of seemed like this since the end of March. Markets are looking past this conflict.
That was certainly since the end of March, and then kind of got an extra boost around Memorial Day when there was first reports that there could be a deal. It's obviously taken a few weeks to get to this point where both countries sort of acknowledge it. I think the markets and investors were already kind of ready to move past the story. The details certainly matter for the geopolitical element, but for the markets, what matters is how many ships are going through the Strait of Hormuz. Like, that's the bottom line. And if those are going to start flowing later this week and sort of normalizing, say, by the end of summer, that's what the markets care about.
Yeah, so they just want to see it open, right? And things moving around again.
Exactly.
Energy markets, though, will still take some time to get back to where they were pre-war, right? I mean, we've talked about this. We look at futures contracts when it comes to oil, and prices still have stayed elevated. It will take a while to build up reserves, get back to where we were, though. And so we'll still feel that higher energy price impact?
We'll still feel it, but you think about in terms of inflation. The impulse for inflation, in some way, the May data we got last week for CPI, that might be the peak year-over-year measure. And so if oil just stays where it is, or even goes a little bit lower, gas prices go lower, then inflation shock has a one-off level, and then it starts to sort of dissipate.
So is that why you think the Fed, the next move will be a cut? You think they're going to cut not next week?
No.
On Wednesday?
No. So we're calling for 2 cuts in 2027,
okay.
March and June.
Okay.
I want to go back to what you said about oil, because I think from what Tyler just told us, there's a chance that even after 60 days, there is no sort of back to normal with the Strait of Hormuz, or the back to normal is some sort of tolling feature. And Tyler shared with us the details that are known now. We obviously don't know what will happen in the future. Is there always going to be, from this day forward, some sort of risk premium on oil as a result of this?
I mean, there's likely to be some geopolitical risk premium. Like, how much is that going to be? All else equal, suppose this not ever happen, is it incremental $5 more? I mean, that's the markets will determine that over time. From an economic perspective, you think about their risk markets, fixed income markets. I think a key point to distinguish is that oil right now, this is a spot market, and so there could be a lack of supply and demand. Mm-hmm. Equity markets are pricing on future cash flows, even bonds. And so even if it takes 60 days to sort of normalize, I think the key thing is that the upside tail risk of oil going much higher, that's been truncated. It already was, and this kind of further takes it down. It also means then the risk for inflation further rising or getting stuck that also goes down, which also means like that's why you see the market expectations for the Fed shift. That's the key thing. Maybe if it's a month, 2 months, 6 months, but if it doesn't get worse and the general path is getting gradually better, I think that's the key thing for equity markets. And the difference between ultimately for the U.S. economy between let's say it's $70 a barrel for Brent or WTI versus 75, that's not going to be the key thing that's going to drive the equity markets. So I think that's, if it's an extra $5, not great, but that's not a game changer for the overall outlook.
What about Israel? Is it still, though, the possibility? I'm just looking at some of our stories from earlier. President Trump telling Israel to stop as Lebanon attacks risk the Iranian deal. We've just seen a lot of reporting, and just when we thought we were making some progress, Israel's certainly on its own path. And we understand everybody's got its own mission and its own goals, but is that still a risk here?
Look, it's certainly a risk, and I'm not going to, trying to put a probability on like how things could escalate. When I think of, like the U.S. and Iran, certainly for a while, the thought was the Iranians would be willing to kind of wait longer. They have greater incentive. The Trump administration would maybe have a more incentive to reach a deal sooner. Just from a political perspective, domestically, it's not as popular. But the fact that there is a deal, and sort of, geopolitical experts that I will talk to, they say the Iranian regime also, is under some stress. So both sides, those parts, I think, do want to reach some sort of deal. Mm-hmm. The fact that the details have not been worked out, but they're willing to publicly acknowledge it, to me says they're both trying to get there. How they deal with Israel, that's a different matter.
I think also how they deal with the nuclear material is the really challenging part of this.
Agreed.
And we're going to spend a good portion of our 3 o'clock and 4 o'clock hours talking about this, Jason. But just from your view, I mean, something that has to come essentially has to be better than the JCPOA, because that's the agreement that the president at this point walked away from. How do you get better than that?
Well, that's a political question. I think from the market's perspective, I'm not sure it has to be better or worse.
Oh, okay.
Not necessarily materially. If this leads to lingering ongoing uncertainty, if the risk is that at any point in time, Iran has demonstrated they can shut down the strait, if that is something they're willing to to have in the back of their pocket, then that is certainly a kind of an ongoing lingering risk. But unless that happens, like the markets are oftentimes priced on a base case, not the risk case. Mm-hmm. And so it's extra risk, it's extra downside risk, but the details of that, I'm not sure that specifically would matter for the markets in great detail.
So are we really safe to say and smart to say it's going to be a different Iran going forward? I mean, Iran, of course, has been the catalyst for so many different terrorist groups, or supporter, if you will, right? I mean, do we truly think that this is now a different way forward for the region and for Iran specifically?
I think the only thing I would say with any sort of confidence is that there's a change in leadership, given what's happened over the past few months. Anytime there's any change in leadership in any country, you often see some sort of policy shifts. Now, whether this is incremental change or does it lead to some sort of more fundamental shift within Iran, that is, again, time will tell. But the fact that, again, there's negotiations, what I hear from sort of more experts in the space is that there's a little bit more pragmatism, among the Iranian leadership, maybe less ideologically driven, but again, time will tell how this plays out.
Well, let me just throw you. There's a great story in the Bloomberg. I loved it. I kind of freaked out when I read in this morning. Wall Street gets access to catastrophe models for the age of war. The number of countries engaged in external conflicts has nearly doubled since 2008. The economic impact of violence now stands at almost $22 trillion, and that risk experts are adapting methodologies used to predict natural catastrophes and other threats to help investors, blah, 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 blah. We know that this is a part of what any financial entity does, but it does seem like it's amped up. Do you guys talk about war and more war potentially than you ever did, maybe in the last 5-10 years? And forgive me, just about 30 seconds. I
would say, generally speaking, we're in a world that's gone from sort of unipolar, U.S.-led to multipolar, where there's geopolitical conflicts, there's conflicts and tensions regarding trade, access to resources. There'll be tension points regardless. I think that's the reality. So politics and geopolitics have to factor into how we think about it, because it's not just sort of purely economic decisions. In the 2010s, for the last 20 years, it's been central bank sort of driven markets. Yeah. Now I think it's much more policy driven markets.
Yeah, it does feel that way. Kind of Hunger Games on so many different levels.
A lot of stuff for us and our guests to consider right now.
Yeah, and we consider you're a great guest. Thank you so much. Glad you could be here. Jason Draho over at UBS, the Chief Investment Office.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We're off session highs, still looking at substantial gains for the Dow, the S&P, and NASDAQ. Dow Industrials on track for a record close right now at 51,815 on the Dow, up more than 600 points, up 1.2%. We've got the S&P up 130 now, up by 1.8%. NASDAQ, the composite index, up by 3%. Likewise with the NASDAQ 100 index, full of big tech names, up now by just about 3%. We have got the 10-year currently yielding 4.46 against the backdrop of the VIX, just above 16. The SOX, by the way, the Philadelphia Stock Exchange's semiconductor index, surging by 5.4%. The 2-year 4.06% with the 30-year at 4.96%. Gold up $107 the ounce to $43.26, up by 2.5% right now. West Texas Intermediate crude, major sell-off there, down 5%, $80.65 a barrel. Brent crude, $83.20, lower now by 4.7%. Deal news, American Express has agreed to buy TripAdvisor's reservation management platform, The Fork, for $700 million in cash, bolstering its operations in Europe. Shares of American Express up today on word of that deal, advancing now by roughly 3.5%. TripAdvisor up by 5.6%. And Salesforce has agreed to buy Fin. It's a firm that develops AI-powered customer agents for about $3.6 billion as the software company works to win new business for enterprise AI. Shares of Salesforce down 0.4%. Recapping, S&P up 1.7%. West Texas Intermediate crude $80.64 a barrel, down now by 5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Kellett. Carol and Tim. That's a Bloomberg Business Flash.
All right. Thank you so much, Charlie Pellet. Carol Massar, along with Tim Stenovec, live here at Bloomberg headquarters in New York City. Having said that, it's interesting. We're obviously watching the war, and we just kind of covered all of that in terms of the market enthusiasm that's playing out. Also playing out is, again, we're focusing on what is the world's largest IPO. We're talking about SpaceX. Successful launch on Friday. We continue to see the stock shooting higher today. Shares jumping in their second day of trading, adding to gains following a blockbuster debut that instantly vaulted this company into the ranks of the world's most valuable public companies. Now, keep in mind, the offering syndicate for the IPO included several lead underwriters, including JPMorgan Chase. The list, to be fair, though, of all the banks involved reads like a who's who of Wall Street's biggest and best known banks.
We got a couple of voices joining us with an inside look at how all of this played out and continues to play out at this point. Bailey Lipschultz is Bloomberg News IPO reporter. David Bauer joins us too, head of Equity Capital Markets Americas over at JPMorgan Chase. They both join us here in the Bloomberg Businessweek studio. Dave, good to see you. Bailey, I feel like
usual, yeah. It's like I badge in, I badge out.
we are always seeing you, and we're lucky. SpaceX, of course, the largest IPO ever. I'm just curious from your view how you think market participants right now, Dave, should be looking at this in the context not just of other potential IPOs in the future, but really in the context of everything we're seeing out there right now. The talk of people taking money from other assets, selling that, getting into SpaceX. Just your view.
Yeah, I think, first of all, for somebody in the ECM world, what a time to be alive. Like these are great times for the markets. And I think unlike other cycles we've seen where IPO issuance has been extremely active, you have a real catalyst forming the investment thesis behind this. This is the reindustrialization of America. We're creating new ecosystems, new economies. You think about what space could become, what AI could become. These are investment theses that many people haven't been able to invest behind before. And so I think seeing this euphoria in the IPO market is warranted and appropriate.
What's the signal to the market and market participants specifically?
I think right now you're seeing that the IPO worked, and you saw Friday a very strong trading with the stock finishing up 19% from the IPO price. And I think today you see broader markets rallying on the news with Iran peace treaty, and you're seeing just more enthusiasm coming in. So I think
SpaceX up another 15% today.
Exactly. And so I think it's all systems go, to make a pun intended for SpaceX. But I think if there was any hesitancy of should I continue to buy up 20%, I think the answer is yes. And if you look long enough, there's this is a business that could be generationally transformational.
But thinking about the generational transformation, Dave, when I look at the pipeline or the kind of group of companies that could be coming public, they don't look like SpaceX. When you're meeting with people, maybe at your former employer, KKR, talking about something in their portfolio, a number of other private equity firms, what are they looking at? Obviously, this is a big one for IPO buyers, But does that translate to someone who owns, say, software companies or other companies in other industries?
Look, the mega IPOs are getting the headlines right now, but there's been a very active and very accommodative equity market in general throughout this year. And putting SpaceX aside, new issuance volumes are up almost 2x this time from last year. And the vast preponderance of that has been other sectors. And we've seen healthcare coming back. We've seen biotech issuance coming. We're seeing industrial, energy. So the markets are working at large.
But aren't all those themes still off of AI in some capacity? If the bottleneck is power and I'm a power company, then I at least have an AI pitch. Because when I look at it or talk to folks, it's kind of like your TAM is either infinite because you have AI behind it, or it's zero because your software, and the worry is that your kind of total market could be at risk. How do you think about kind of other industries and how that fits into that?
Yeah, I don't think the market is shut out for certain issuers. I think it does come down to price and having the right starting point in the public markets. And I think there is a bid for those other businesses. You mentioned sponsor-backed businesses. It's a good time to, what I would say, get the puck on the ice, start it. And, we always say when we're advising our clients and our issuers, proof points in the public market are worth even more than in the private market. And so getting out there, starting it, and you can see how your valuation can expand as you perform. You can get your share price to a level that you might be more interested in selling at, but getting started can be helpful.
What is it about this moment right now, Dave, that is compelling so many of these companies, not just to go public, but also to look into going public? And I am going back to sort of the companies that when they do go public will become mega cap companies.
And just to tag on to what Tim's saying, opportunistic or fundamentally based?
I think this is a more fundamental based market, and you look back to 2021, which felt a little bit more technical. It was like rates were zero, and so therefore equities were attractive, and you had a very different dynamic that drove that. I think this is much more of a fundamental. I think the market is looking at what the next 3 to 5 years could be, and potentially looking past some of the near-term volatility. And it's not saying they're ignoring downside risk, but I think saying there's certain businesses right now that are very much worth investing in. There's a whole slate of new issuance that is different than the portfolio I've had in the past, and I'm going to take that opportunity to invest in it.
I am thinking, though, about those mega IPOs, be it Anthropic or OpenAI. Should we make any assumptions about their market reception just because of what happened with SpaceX?
I think, SpaceX is an N of one of itself from the fact that no one else is doing space at this scale, at this velocity.
But it's an AI play.
But it is an AI play. But where I was going with that is, I do think, this bodes, if you're Anthropic and OpenAI, you're applauding that this type of market reception happened. And, the size of the deal getting done, having it trade as well as it did, to me, that gives even more confidence that the next wave could get done in a very positive way.
Well, when we look at what the next few months can look like, back to the broadening out, is AI still the flavor of the day? If we look at some of the reports that are out there, and SK Hynix or other large companies in the AI space looking to tap the market, like Carol was mentioning, because of these tailwinds, and kind of what does that mean for this July, this August class?
Yeah, I think we're going to have a very active summer. Even the SpaceX period of time. A lot of people thought coming in we'd have a dearth of issuance and you'd have a real quiet period. We did $10 billion of equity capital outside of SpaceX last week. And so, the market was still working. There were still a ton of deals getting done. I think this CapEx cycle, to your point of AI, people still want to invest on it. And that's across equity, debt, all the facets of capital here. And so the public markets are helping that, but it's also the private capital markets as well. We're seeing capital formation in almost every corner of the capital markets.
You oversee ECM. I come back to the point that Google, Alphabet, however you want to call them, raised close to $90 billion across a suite of products. Is that something we should expect from all these hyperscalers who need capital to tap the equity market? And is there any risk that gets oversaturated?
I think the speed at which Google is able to raise in the public markets shows the depth and the capacity for the capital markets. And I think as long as companies are showing an ROI and a good use of proceeds to raise that equity capital, the markets will be there for them.
How do we know when it becomes uncomfortable, crazy, exuberant?
Frothy?
Well, think back to 20 and 21. It's easy now to say that these were companies that were advantageous, but in the moment, did it feel that way?
I go back to when you look at fundamentals and you look at valuations, we're not terribly stretched and we're not at a new point in time. And you go back and you look at, for example, software valuations in 2021, those were hitting new highs and they were hitting kind of new records of where the market was trading at. We're not seeing that writ large in the public markets.
But SpaceX isn't profitable.
No, it's not. But it's being valued on a sales multiple for 2025 sales, and I think that some people have come and sat here and said, it's starting to feel like, when we're valuing IPOs on sales multiples, it's starting to feel a little bit like the .com boom. Why is this time different?
I think that's unique. One, SpaceX, I think, is its own animal. And I think when you're thinking about the space economy, you have to look at that in a very different way. I don't think you're seeing the rest of the market being valued aggressively on a sales multiple or other metrics where people are trying to extend and get comfortable with it. I think these are based more on fundamentals. It's based on growth right now, and people are seeing where the capital being laid today has a return in the future. And I think you can pull that forward, and that's what's going on.
But the circular financing doesn't worry you guys, or we have this conversation a lot. Are we stupid to have that conversation about a company that seems to buy from another part of its properties or invests in a chip maker because they need to, you know what I'm saying? What's the conversation you guys have about that circular financing?
What keeps me sleeping well at night about this is the fact that we're having the conversation. And I think if people are acknowledging it, we're talking about it, you're dissecting it, you're diligencing it, I think the cycle has room to continue and to grow. I think it's the unknown risks, not less the known risks that I think could derail the cycle.
And when we look at this market, is there a risk in kind of just thinking about the difference between a hyperscaler who has historically been the best cash flow cows in the history of mankind? They can at least turn off spending. How do you think about companies that are spending and need to spend but don't have hundreds of billions of dollars annually or biannually in terms of free cash flow?
Yeah, I think you have to look at the fundamentals of the contracts. What is a contract? What is contracted from the demand build that they have today, and get comfortable that what they're investing in right now has the right economics to yield a return in 3 or 5 years. And I think you're right. They might not have the free cash flow spigot today, but you look at what is contracted and what could be come to fruition in a high quality way in the next 2 to 3 years. You can bridge to that free cash flow.
We've got 30 seconds left here. You've been covering this market. What do you want to ask Dave?
Do we see more private equity IPOs in the second half, or is that still an area, broadly speaking, that's touch and go?
I think definitively yes. I think the market would be accommodative for that, and our backlog suggests that we will have a number of those in the second half.
In about 10 seconds, how much does how much does leverage ratios matter for those companies?
It matters. I think you want to get it to a comfortable starting point, but I think for good free cash flow stories with solid, predictable revenue and growth, the market can get comfortable.
So welcome to our regular weekly segment. We'll see you both here back on Monday.
Guys.
Billy Lipschultz, of course, Bloomberg News IPO reporter, Dave Bauer, head of equity capital markets Americas over at JPMorgan Chase. When we come back, what may determine whether stagflation becomes a real risk? We'll explore that when Bloomberg Businessweek Daily continues.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We begin with a developing story. California Governor Gavin Newsom is accusing President Trump of ordering the U.S. Department of Justice to investigate him and his wife. In a video statement, Newsom said the Trump administration is targeting him because, quote, he's considering running for president.
One by one, anyone who has challenged Donald Trump has ended up on his hit list. And today, I proudly join that list.
California Governor Gavin Newsom. Stocks are higher. We are, however, off session highs. The Dow Jones Industrial Average on track for a record close right now at 51,800. This after the U.S. and Iran agreed to reopen the Strait of Hormuz. That word sending oil lower. Stocks are rallying. The S&P at 7563, up 131 points now, up 1.8%. We've got NASDAQ up 778 for the NASDAQ Composite Index, a gain of 3%. The NASDAQ 100 index doing slightly better, up 3.1%. All of this with the SOX, the Philadelphia Stock Exchange Semiconductor Index, now higher by 5.6%, and the VIX holding right around 16. 10-year 4.46%, with the 2-year currently yielding 4.06%, and the 30-year yield 4.97%. Gold up 2.5%, $43.25. West Texas Intermediate crude selling off by 4%. 4.7%. 80.88 a barrel. Brent 83.27, down now by 4.6%. SpaceX shares surging again now, up by 16.1%. You recall Friday, IPO day, they were up by 19.1%. Recapping, S&P 500 index up now by 1.8%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol, Massar, Tim Stenovec live here at Bloomberg headquarters in New York City. Yes, indeed, it is Monday, and there's a bunch of things we're watching. Obviously, the developments regarding the U.S. war in Iran, and it does seem like there's market enthusiasm. Although, as we just heard from Charlie, we're definitely off our highs of the session. We've also got a Fed meeting, the first one with Kevin Warsh presiding over.
Yeah, I mean, we're going to be flying to Las Vegas.
We're kind of bummed about it.
We've got a show on Thursday.
Watching the tick by tick of a Fed.
Yeah, I kind of have a little FOMO, I'll be honest.
You and me both.
Yeah,
Especially
we'll see if the plane has Starlink and we can actually tune in. If not, we'll land. We have no idea what's going on.
Right, exactly.
That's
Surprise.
That's healthy too, though.
Yeah, it is.
Occasionally.
Kind of tying it all together, our next guest is watching the 3 Ds, duration, devastation, and disruption from the Iran war. She notes that these indicators will inform whether stagflation becomes a real risk rather than a headline. So we want to get into it with Rebecca Humkes.
She's lecturer at the London Business School, faculty at Duke Corporate Executive Education. She previously served as a fellow at the White House's President's Council of Economic Advisors. She's also the author of Survive, Reset, Thrive, Leading Breakthrough Growth Strategy in Volatile Times. Sentiment shift yet again in global markets because of the U.S. war in Iran. Does the recent action around what people are calling a ceasefire right now feel like, in your view, we are indeed nearing the end of this conflict?
Hi, Carol, Tim. Great to see both of you again. I think we are all, most CEOs and executives are looking at today's news with some healthy skepticism. We've been a couple days away from a deal basically over the last 100 days. So there is hope that we will seal a deal on Friday. But until some details are announced, it's very difficult to do anything more than just wait and see what details we get.
So if an executive or leader's calling you, you're going to say, you got to wait here.
It's a wait and see. Now, I think we already knew what was going to happen in the Fed meeting this week. It's very unlikely that the Fed makes any moves. Doing nothing is doing something, as we've spoken about before. This really just further puts pressure that we will see maybe a little bit less talk of putting a potential rate change. So I think that kind of just solidifies what we already were expecting for this week's Fed meeting, but any other decision making is absolutely wait and see. We don't just need details. We need to show that this deal will actually go forward and be acted upon. There's just been too many false signals over the past couple of months. Now, remember, companies and executives, they've built this preparation in. So uncertainty is the new certainty. Shifts are something that are just part of the normal course, but no changes are being made based on the anticipation of a deal.
I want to table that just for a minute. If we do talk about the deal, the context of that is oil prices and the inflationary elements around energy prices, fertilizer, and everything that we've been talking about over the last 3 months that go through the Strait of Hormuz that can affect prices. The other side of the Fed's dual mandate, labor and the labor market. I'm just wondering what you're hearing from executives right now. Sometimes we hear anecdotally about a low hire, low fire environment. We see all the same data that you and the executives see, but what are they telling you about the environment?
So on a macro level, no hire, no fire, it roughly describes the situation. But frankly, I think that headline is disguising a much more nuanced storyline. If you wipe away kind of month to month, what we're seeing is, first of all, we unequivocally did get a good jobs number earlier this month, and we shouldn't take away from that. Over 170,000 jobs is great and signals, it's a relatively healthy economy. But digging in, really the only sector that's added jobs in the past year and a half is healthcare. And the majority of the boom that we got in June was in leisure and hospitality, which we expected with the World Cup bump coming. So it's difficult to see whether or not those will stay forward. Now, certain talent, yes. One of the number one strategic bottlenecks for most organizations is still hiring the talent that they need, but there are not a lot of open positions right now, linked very much to economic uncertainty and very much to potential AI gains in the future. When there are layoffs or retirements, there's a lot of these positions just aren't replaced. So that's why we're still seeing this roughly no hire, no fire, Tim. So I'd say 3 good months is good, and let's not take away from that, but we're not really seeing a shift in what we're thinking about the macroeconomic economy right now.
So wait a minute, you just said there's open positions. Folks are having trouble, Rebecca, finding people.
Yeah, it's a bit more nuanced. So there's certain talent positions that are always a bottleneck.
Okay.
So very skilled workers in our manufacturing sector, kind of very talented digital employees in certain aspects. Carol, those few positions that are always a critical bottleneck, those will remain a critical bottleneck. But most organizations are not doing the overall replacement. So when there's the normal turnover and the normal retirements, a lot of times those positions aren't opened back up again. So the one in, one out that might happen, open new strategic priority, hire several new people. Yeah. There's a lot more pause put on hiring right now. Again, economic uncertainty, number one reason. Potential gains from AI in the future coming in is the number two.
AI, is it still too early? I mean, we are seeing things, and there's certainly an impact already, and certainly leaders talking about it. And I just feel like maybe leaders aren't being as forthright as they need to be when it comes to the impact AI is going to have on the labor force and what they need.
So as of right now, there has been almost no replacement of jobs with AI. There's a little bit of macro data that maybe some entry-level roles are being replaced, but the data we're coming in from this summer maybe is wiping that away. When we are seeing layoffs due to AI, it's less about replacement, it's more about reallocation. So to move cash flows to different areas of the business to justify this AI investment spend, it's more of reallocation. A lot of us are also seeing is restructuring. So organizations tend to get bloated over time. They tend to add functions, they tend to add teams, they tend to add layers. We're seeing a real push to kind of de-layer a bit. So I think it's less about replacement, much more about reinvestment, reallocation, and restructuring, and partly just a rectification versus maybe lack of discipline that's happened over the past couple of years. Now, we are in early days, and it's possible those things will happen. But inside organizations right now, gains are still very much held for a productivity and efficiency level at the team or individual level. There's very little cross-team and definitely organization-wide efficiency gains that could justify any sizable level of job replacements.
Hey, since we promised and teased that these 3 Ds that you're looking and what it says about stagflation, I want to just save the last minute or so. Is stagflation still a possibility here in your view?
I don't think stagflation ever removes completely from the situation. Here's where we have a different story in the US versus the Eurozone versus the UK. 3 months of a healthy jobs number does take a little bit of pressure off. What we're also really looking for is not just this month's PCE, which is going to be a bit backward looking, but going into July. If we see 1 or 2 months where that core inflation number doesn't move much, and we can see that this was very much a supply shock, and we always hate to use the word transitory again, but it was there, then yes, those fears would be taken down. So I think, Carol, less so than we might have said 2 or 3 months ago, but we still need to see, if the deal is signed. But again, even if the deal is signed, it doesn't mean that oil prices drop down and that translates to consumer gas prices. We need to have a lot of understand what's going to happen to the strait. Are there going to be tolls charged? How do potential different waterways around the world? What's happening reserves? Right. There's about another 8 to 10 data sets that we would need to make that decision. All right. But as of right now, we're looking at a stronger economy than we were about a month ago.
All right. Good end on some good news. Rebecca Humkes, lecturer at the London Business School, faculty at Duke Corporate Executive Education. Previously, she was a fellow at the White House's President's Council of Economic Advisors.
When we come back, a check on trading and stocks on the move.
This is Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody, we're heading into the last hour of trade on this Monday. Carol Massar, Tim Stenovec.
That was quick.
I know, time flies.
Time flies.
When you're having fun. Having said that, we're definitely off our highs of this session. Enthusiasm, though, and fingers crossed, optimism that we're making some progress in terms of ending that U.S. war in Iran. So that is certainly front and center. S&P 500 right now, though, up about 131 points. That's good for a gain of about just shy of 1.8%. If you round it up, it is 1.8%. Dow up almost 600 points, 1.2% to the upside. Talk about a risk on trade. You've got the NASDAQ 100 better by 911 points, Tim. That's good for a gain of 3%. That average, I should say, is just below its highs of the day.
Okay, interestingly enough, the yield on the 10-year falling 1 basis point. And then it looks like the yield on the 2-year falling about 2 basis points. But you get to the longer end, Carol, and we're actually seeing yields up ever so slightly on the 30-year.
Yeah, so interesting, right? And the reason we're pointing it out is we do have an FOMC meeting on Wednesday. We'll get a Fed decision. It will be the first one that Kevin Warsh will be at, and as chair of the Federal Reserve, and of course that press conference. So it'll be interesting to see what he says, how he says it, and how he conducts it all.
Everybody will be watching for signals, for signs. I want to hear what the president thinks of it.
You mean if they do nothing?
I think many people think they will do nothing.
Most people say they should not do anything because of the macro, right? And that's
not only that, but they think that they won't move rates at all.
Yeah, this year, right?
Yeah.
Some have even talked about a
We'll
hike
see.
later on this year. All right, I'm Carol Massar along with Tim Stenovec. Let's get to some stocks on the move. With us is Bloomberg News cross-asset reporter Denitsa Sekova. She is here in studio. Fox, we were talking about Fox on Friday. Not Fox on Friday. We were talking about what Fox bought today.
And the reaction on Friday was very good. Roku was up 20% on Friday. We're seeing completely different reaction. Roku itself is down just about 1%. But the reaction we're seeing from Fox shares, the ticker is FOXA, tumbling 17%, really not catching up on that optimism we're seeing in tech stocks and stocks more generally. It's coming off this news that Bloomberg reported on Friday that Fox Corporation has agreed to acquire Roku in a deal that's valuing it about $22 billion, including debt. We're seeing quite a reaction there. This is not the first such acquisition we're seeing from Fox. Of course, we saw Tubi, and Tubi has been growing really fast for them. They acquired it in 2020. It has about 100 million subscribers.
Can I watch the World Cup on Tubi?
I don't know. You should ask them.
That's what I'm trying to figure out.
If you're happy to watch the ads,
Okay, all right.
I don't know.
I think the ads, you have to watch the ads.
Yeah, that's the thing. Both Tubi and Roku, they have really pushing that free.
Tubi, T-U-B-I, Tubi
Quick Search offering
Are they offering it?
Free streams of selected major matches
Okay.
and the
Selected
opening
major.
ceremony.
Looks like I'm paying for another streaming service.
Here we
2026 FIFA World Cup. Quick Search.
Well,
I pay for like a dozen streaming services. It's insane.
That's what they plan to do. They plan to keep them separate so you can pay for a few more. So
Great.
Tubi and
Can't
Roku
wait.
will be separate. They both have about 100 million monthly users. But there has been this big move. Obviously Netflix is offering cheaper tier subscriptions if you're happy to watch the ads. So it's been getting pretty competitive. It's very interesting that if these deals happen, this will be the third largest US television/streaming platform. And it's going to be huge. And it means a lot of competition for Netflix and Amazon. So very interesting space, but clearly investors are not too happy when it comes to the Fox stock. And that's actually not too great for the deal because the deal includes Fox stocks as well.
It's getting hammered.
Yeah, my top decliner a little later. Just
Nice.
to give everyone a
I think
preview.
you're going to be safe with that one.
Talia reminds us that Tubi's free.
Yes.
But if I want to buy the other matches, I'll have to pay for some sort of another streaming service. Sebastian Escobar reminds us that you can watch on Telemundo on Peacock if you want to watch the games in Spanish.
Muy bien.
Yeah.
That'll be fun.
Yeah,
Cool.
exactly.
That's fun.
All right, let's go to SpaceX. Second day in a row, second day as a publicly held company.
Just second day, and then superlatives don't feel like a second day. So just today, the stock is up 16%. Of course, the ticker we've been talking about is SPCX. Up 16% today, 19% rally on Friday. And the numbers are just crazy. It's already the sixth most valuable company in the US. Just today, the value added is 340 billions, and the market cap is 2.4 billions. That is so
2.4 trillion.
2.4 trillion.
Yeah.
That's just a few hundred billions below Amazon. It's just crazy that in the span of 2 trading days, we're getting so close to some of the biggest companies.
One of them's profitable, one's not.
Yeah.
That's a quiz.
That's an aspect to it. But it's all about the future cash flow.
That's what I'm told. Yeah.
All right,
Yeah.
It's all about the future.
You're betting on the future, right?
Yeah.
And
It's
future
very
businesses. Just got about 30 seconds. TripAdvisor.
Oh, we've been seeing that trend of major financial companies pushing deeper in hospitality consumer experience. That's what TripAdvisor does. They have sold their The Fork, which is like a European booking service, to American Express for $700 million. And American Express now has a few. They have Resi, they have Talk, and now they have a Fork. So you go to American Express, you book your trip, you book your dinner, you book everything.
What? It's too much?
Too much? Yeah, I know. I like calling the
Carol,
restaurant.
have your AI agent do it.
Yes, just build your cult.
It's just so, I don't know. Yeah, actually, I think that's what people say, that using LLMs for travel, especially when you're in a bind, is really useful.
Just do it.
All right, Denitsa, thank you so much. Denitsa Sekova, she is here in studio, Bloomberg News cross-asset reporter. Check out Stock Movers, our podcast, 5-minute episodes. You can find it on Apple, Spotify, or anywhere you get your podcasts.
Hey, coming up next, it is the biggest geopolitical story. It's the biggest market story today, the latest on the U.S. and Iran and what happens to that nuclear material. If you're watching on TV, the close starts now.